Good morning. So today's class we'll be discussing about the types of insurance. Insurance can be mainly classified into two, life insurance and non-life insurance. We usually say it's classified into life insurance and general insurance, but as per this chart, we'll explain it as life insurance and non-life insurance. The non-life insurance is again classified into general insurance and other miscellaneous insurances. General insurance mainly consists of marine insurance, fire insurance, and social insurance. We are all familiar with the term life insurance. Life insurance provides protection to a person's life, usually to the breadwinner of a family. The person who earns income for a family is very important for the existence of that family. Therefore, if something happens to his life, then the insurance will provide a compensation or for the loss that is being suffered by that family due to the death of that particular person. So life insurance is nothing but the protection given to a family against the risk of losing a member of the family. Now, non-life insurance consists of general insurance and miscellaneous. These are the types of insurance that does not include insuring the life of a person. See, marine insurance is the first one in general insurance. Marine insurance provides protection to ships that are out there in the sea to either transport cargo to another port or they are there for other reasons related to trade. So marine insurance ensures that all the losses that are inclusive of the marine adventure is covered. It covers loss or damage to the ship, the cargo, the vessel, or any other subject matter of a marine adventure. So marine insurance provides protection to the ships at sea. Fire insurance provides protection against the loss suffered due to an unexpected fire. Even after a person has taken all the necessary requirements to make his organization or house fireproof, if he suffers from some sort of a loss because of fire, then that loss will be compensated by the insurance company according to the fire insurance policy. Third one is social insurance. See, there are pension plans, disability benefits, unemployment benefits, sickness insurance, industrial insurance. These are all different forms of social insurance. It has been developed to provide economic security to the weaker sections of the society. Now, to provide security to the weaker section of society, various types of social insurance policies have been developed. It includes pension plans, disability benefits, unemployment benefits, etc. Now, there are miscellaneous other insurance policies as well. There's motor insurance policy, which provides protection to commercial as well as private vehicles. It includes four-wheelers or two-wheelers or three-wheelers. So they are mainly covering two risks. The first one is the risk arising from damage to the vehicle by fire or accident or loss due to the theft of the vehicle. Okay, so we could face damage because of fire or accident or theft, and this risk is covered under motor insurance. The second type of risk that they cover is personal injury to the owner of the vehicle. In case you suffer any loss while you were using that vehicle, you met with an accident, you were hospitalized, then those expenses will be covered under motor insurance. The third type of coverage that they give us injury or death of a third party due to an accident wherein the vehicle of the insured is involved. Now you went and hit someone and that person suffered a loss. You need to go and get him hospitalized and all that expenses will be covered under motor insurance. The loss of your vehicle, loss to your own self, then loss to some other person, third person will be covered under motor insurance. Third party insurance. Besides the risk of personal injury to a third party, there is also the risk of damage to his property. So in case we go and hit another person's vehicle and that person suffers injury, then the risk of damage to the property of the third party and the risk of personal injury to the third party is covered under third party insurance. So we can claim insurance for hospitalizing the third party and also to get the vehicle of the third party repaired if we have caused any damage to his property. It need not necessarily be a vehicle. We might have went and hit into the wall of a person, a compound wall, then we can claim insurance for construction of that compound wall also. That is with regard to third party insurance. Then there is employee liability insurance. Employers have a liability towards their employees. So this one's employer liability insurance. Sorry, it's EMPLOYER. So employers have got a liability towards their employees. In case the employee suffers any bodily injury during the course of their employment, then the employer will have to compensate for such accidents. And he can take insurance on to cover this risk, and then he can claim insurance if any of his employees suffers from an accident while he was carrying out his daily duties. There is fidelity guarantee injury, that is fidelity guarantee insurance, which is suppose the accountant or the person cashier who's handling the cash of your business, they were dishonest and they stole from you and you had to face monetary loss, and this loss can be insured by the employer under fidelity guarantee insurance. Burglary insurance. Under burglary insurance, all risk from burglary, theft, robbery and all is covered. Now you might wonder what is the difference between burglary, theft and robbery. It all sounds the same, right? But there is some difference. See, theft means someone steals from you and you do not actually notice that your property has been stolen until after some time. Okay, so maybe pickpocket or something. That is an example of a theft. Now, robbery, we have heard of bank robbery. It's usually an armed attack. You're pointing a weapon at someone or you're threatening to harm someone and thereby taking goods. That is an example of a robbery. Now, burglary includes you are trespassing into another person's property. You're breaking and entering the house of a person at night with the intention to steal from there. That is a case of a burglary. So burglary insurance covers all these three circumstances. Next is cattle insurance. This is meant for cows, buffaloes, etc. They cover the risk of the farmer because of the death of these animals due to natural calamities, strikes, riots, terrorism, etc. Health insurance, it is in case of illness or injury suffered by the insured or his dependents. Health insurance covers their medical expenses. Now there is specified disease insurance also, whereby we can insure against a specific disease. I want protection against cancer. I want protection against COVID. That is all examples of specified disease insurance. There's also aviation insurance. It includes large commercial airlines, corporate aircraft owners, private owners, flying clubs. These people will get their aircrafts, and passengers and third-party insurance will all be taken under aviation insurance. These are different types of insurance. There's mainly, we'll see there is life insurance and general insurance. But as per this chart, there is life insurance and non-life insurance. Non-life insurance has been classified into general insurance and miscellaneous insurance. General insurance has again been classified into marine, fire, and social insurance. So in this module, we are required to learn in detail the different life insurance policies, marine insurance policies, and fire insurance policies. So we look into the different life insurance products or life insurance policies. What are they? The different types of life insurance policies are classified on the basis of duration, on the basis of the premium payment, on the basis of profit participation, on the basis of number of persons insured, on the basis of methods of claim payment, on the basis of ULIP, that is unit-linked insurance policy. And there are also other products under life insurance policy. So we look into each of these categories in detail. First one is life insurance policies on the basis of duration. It has been mainly classified into three. There is whole life policy, there is term insurance policy, and there is endowment policy. So what do you mean by a whole life policy? Now, whole life, like the term denotes, it's a policy which is taken for your entire life. You will be given um, insurance amount once you have completed your life cycle and you have died. Only the once the insured has died, the insurer will pay the amount. That is known as the whole life policy. So there are different types of whole life policy. There is ordinary policy, limited premium, limited payment, single premium, convertible policy. So what are these? See, in case of ordinary policy under whole life policy, the premium is payable periodically throughout the life of the assured. As long as the assured person is alive, he will have to pay the premium amount periodically. That is the case with ordinary policy. In case of limited payment whole life policy, the premium is payable only for a specified period. He need not pay the premium during the entire period of his life. He need to pay it only up to a specified period for maybe 20 years or 25 years. That is the case of limited payment whole life policy. Now, single premium whole life policy, as the name denotes, the entire premium is paid initially as a single payment. We'll be paying the premium only once the whole amount will be paid initially itself. Then there is convertible whole life policy. According to this policy, the policy holder gets an option to convert their whole life policy into an endowment policy at the end of the term period. So they can convert their whole life policy to an endowment policy if they wish to do so under convertible whole life policy. These are the four categories. Under ordinary policy, premium is paid during the entire period of life of the insured or the assured. Under limited payment, the premium is paid only for a specified period. Under single premium, the premium is paid only once. And as per convertible whole life policy, the policy can be changed to endowment policy at the option of the assured person or the insured person. Now, the second type of life insurance policy on the basis of duration of policy is term insurance policy. Term insurance policy is classified into two. There is renewable policy and convertible policy. See, term insurance policy, as the name denotes, is taken for a specified period of time. Okay, you're taking that insurance for a period of 5 years, maybe for 3 years, maybe for 1 year. And insurance amount will be paid only if something happens to the assured or the insured during that period of time. Okay, he has to die within 5 years to get the insurance amount. Something has to happen to the insured within a period of 3 years if he has to get the insurance amount. Not he will not get, obviously. His beneficiary, whoever it is, nominee will get the amount only if something happens to the insured during the period of the insurance. So usually the premium paid on this type of insurance is comparatively lower. It's taken by people who immediately need life insurance, but they do not have much amount with them to spare for premium. They cannot afford to pay a higher premium. So what they will do is initially they'll take term insurance policy and they will get their life covered for 1 year or 2 year or 3 years. And later on when they can save more money, then they will move to some other type of policy. Now, this can be of two types. There is renewable policy and convertible policy. Renewable policy means once the term of your policy expires, you can renew it again without a medical examination. But every time you renew, the premium rate will be increasing accordingly. You can keep on renewing till you reach the age of 55. After that, you cannot renew that policy. Then there is convertible term policy, whereby you can convert your term policy into an endowment policy or a whole life policy. That is the case of convertible term insurance policy. You get the option to convert your convertible policy into an endowment policy or a whole life policy. Now, what is endowment policy? It is a combination of both protection and investment. Okay. See, endowment policy means it is taken for a specified period, the policy, and if something happens to the insured during that particular period, then the nominee or the beneficiary will get the amount of insurance assured. And if nothing happens to that person on completing that particular period, the amount will be given back. The amount that you paid will be given back to you. There is endowment policy. So there are different types. There is pure endowment policy, there is joint life policy, double endowment policy, marriage endowment, etc. So what is pure endowment policy? In this policy, the insurance company agrees to pay the assured or his nominees a specified sum of money on his death or on the maturity of the policy, whichever is earlier. They will get the amount either on the death of that particular person, or once the policy matures or the period for which the policy has been taken is completed. At the end of that period also, the money will be returned back to you. Now the premium is to be paid till the maturity of the policy or until the death of the assured, whichever is earlier. Second type is joint life endowment policy. This policy covers more than one life under a single policy. So you can take insurance coverage for the life of 2 or 3 persons. And this is suitable for partners of a firm. That is joint life policy. Now, when is the amount payable in case of a joint life policy? Either on the expiry of the term or on death of one of the assured. In case one of them passes away, then the other person will get the insurance amount, or if the term has expired, then they will get back the money. Now, double endowment policy, if the life assured dies during the endorsement period, basic amount will be paid. Whatever is the promised insurance amount, that will be paid if the person who is insured dies during that particular period. Now, suppose he survives that period of time and is still alive at the end of the term, then double of the sum assured is paid to you. That is double endowment policy. Now, marriage endowment, it provides funds for marriage of children. The premium is to be paid till the death of the policyholder or for an agreed period. The policy matures after the expiry of the endowment period. And if the child dies, see, we have taken a policy for a particular child, but if that child unfortunately dies, then the policyholder is given an option to substitute the name of another child as beneficiary. He can transfer it to the name of another one of his children. So these are the 3 types of policy based on duration of policy. There is whole life policy, there is term insurance policy, and there is endowment policy. You can expect a question in section A regarding what is endowment policy or what is whole life policy. Okay, so keep in mind, whole life policy is for the entire period of life of the insurance holder. Term insurance policy is for a specified period. Endowment policy means if something happens during that specified period, the nominee or the beneficiary will get the amount, and if he survives that specified period, then the amount will be returned back. So it's a combination of whole life and term insurance policy, endowment policy. Next is based on premium payment. It has been classified into 2. There is single premium policy and level premium policy. From the name itself, it's quite clear what it is. Single premium policy means initially as a lump sum, the entire premium amount is paid by the insured or the assured. Level premium policy means the premium is paid at regular intervals, like on a monthly basis or quarterly or half yearly or yearly, for a definite period of time. When compared with the single premium, the level premium amount is less. But in case of single premium, when we take the aggregate of the payments that we make under level premium, the total that we get will be more than that of the single premium policy. Keep that in mind always. Suppose we are paying 5,000 every month under level premium policy, and you have been paying it for a specified period of time. You add up all the premium amounts and it's coming up to 5 lakh. You have paid 5 lakh as premium. Now, under single premium policy, when you look at the premium amount, maybe they will ask you to pay 4,50,000 upfront as a lump sum amount. Now that 4,50,000 might seem like a huge amount, but when you compare it to the total payments that you will be paying as installments under level premium policy, it will come up to a lesser sum. Now, according to participation in profits, it's been classified into with profit policy and without profit policy. It is also known as participating policy and non-participating policy. Under with profit policy, the insured or the assured person is allowed to get a share in the profits of the insurer, in addition to the sum assured. So they can claim a share in the profits of the insurance company. In without a profit policy or non-participating policy, the insured does not have any right to a share in the profits of the insurance company. They will be only able to claim the insured amount. Now, based on number of persons insured, there is single life policy. In this case, only one person's life will be insured. Either your own life or some other person's life will be insured. Under multiple life policy, more than one person's life can be insured. That is a joint life policy and last survivor policy. Under joint life policy, usually it's beneficial to the couples or partners of a firm. If one of them dies, then the person who has survived will get the insurance amount. That is the case of joint life policy. In case of last survivor policy, the amount will be handed over to the nominee after both of the insured has passed away. Only after the last of the person who is insured dies, the amount will be paid. As long as one of them is alive, no payment is made. That is last survivor policy. Now, according to the method of claim payment, there is lump sum policies and installment policies. Suppose there was a loss suffered by the insured, he passes away, he dies, his nominee can get the whole amount insured as a lump sum amount. We can get the total amount as one payment on the happening of the event. That is lump sum policy. In installment policy, it provides the insured a regular income until death starting from the desired age. This is like an annuity policy. That is, for a certain period of time, they will have to keep on paying the premium. But once they have attained a retirement age, then the amount that is due to them will be paid in installments to them. So it is helping them to survive. It's like a pension that they get. It's an annuity payment. So that is with regard to installment policy. So that is all with in the case of life insurance policy. We know under duration, it has been classified into three: whole life policy, term life policy, and endowment policy. Under premium payment has been classified into single premium and level premium. Under profit participation, we have classified it into with profit or without profit, or participating or non-participating. According to the number of persons, there is single life policy and multiple life policy. According to the method of payment, there is lump sum policy and installment policies. Now coming to what is ULIP, Unit Linked Insurance Policy. Please note that this can also be asked as a question in section A. Unit Linked Insurance Policy. It is one in which the customer is provided with a life insurance cover. The premium paid is invested in either debt or equity products or a combination of the two. Okay, so the person who's taking the insurance will get a cover for his life. At the same time, the premium that he pays will be invested in either equity shares or some debt instruments. And the return from that investment will also be made available to the assured person. So he is getting a protection for his life, and at the same time he is getting a return from the investment that is made in the form of premium. That is an example of unit linked insurance policy. And there are other schemes also. There is salary saving schemes. It is mainly focused for salary earners, those who earn salary. A certain premium amount is deducted from their salary every month. The employees get their salary only after deduction of the premium. And for this, the insurer and the employee will enter into an agreement. Now, the premium will be deducted and remitted to the insurer. It is very convenient to employees and beneficial to the insurer, because they can keep on paying that premium as long as they are in service, and they will get that protection also. There are also group insurance schemes whereby a group of people can get coverage. It is used by government as instruments of social welfare in several countries. Now, group of people may be employers. The insurance contract will be between the insurer and a body that represents a group of individuals covered. Maybe the employer is taking for all the employees in his company. Association, a professional association is taking a policy for the members of that association. So it is for a particular body. The insurance company enters into an agreement with a particular body. So these are different types of life insurance products. I hope this much is clear. The next one is marine insurance policy. So we have to look into the different type of marine insurance policy, fire insurance policies, and then the difference between life and general insurance. And then we'll be completing our portions. So let's look into marine insurance policies. It is quite easier than the life insurance policy. Sometimes they will ask you an essay regarding the different type of marine insurance policy or life insurance policy or fire insurance policy. That's why we have to learn a minimum of 10 or 11 types of policies so that you can write it down in case of an essay question. Now, the different types of marine insurance policy. The first one is time policy. See, in this case, the vessel, the ship is being insured for a particular period of time. It could either be your ship or your cargo, whatever it is, you're taking the insurance for a particular period of time, and that is known as time policy. What is voyage policy? So you're taking the insurance for your ship while it's going from one route to another. You're always moving between two ports. You're taking the same route always to transport cargo from one port to another. So you know the route that you're taking, so you can insure that route. Anything that happens to that vehicle en route can be insured. So that is voyage policy. A particular route is insured. Now, mixed policy means you are insuring your vehicle for taking a particular route for a particular period of time. So no matter how many voyages I make in between two ports during 1 year, it should all be insured. That is an example of mixed policy. So you're going to keep on transporting cargo between two ports, the same two ports, during a period of 2 years. And during that entire 2 years of time, you will get protection for your vessel as long as it's taking the route that has been insured. So that is time policy, voyage policy, mixed policy, and that is valued policy. See, in this case, we are going to decide the compensation amount first. The ship owner is going to say that, see, my ship is carrying this much worth of goods almost every time. So if something happens, I must get at least this much amount. That is valued policy. In case of loss, they will not be calculating the value at that time. They will already have predetermined the value that is to be paid in case there is a loss. That is valued policy. In case of unvalued policy, the compensation amount that is to be paid will be calculated only on the event of loss. Once the loss has occurred, then they will take into stock how much goods was there in the ship, how much loss did the person actually suffer, and then he will be indemnified. We'll keep in mind the actual policy amount also. Suppose we have taken a policy of 50,000 rupees and the loss is 40,000, then the insured person will be given 40,000 as his insurance amount, because we'll only be indemnifying the loss. Suppose he has taken a policy for 50,000 and he has suffered a loss of 60,000, then the policy amount is only up to 50,000. So the insured will be paid only 50,000 rupees. What's the amount to be paid? That will be determined at the time of the loss. That is unvalued policy. Now there is floating policy. It's taken for a very long period of time, and a large sum is paid as the policy amount will be a large sum, okay, and he will be covering a lot of his ships, and every time he makes a claim, then from that total policy amount, the amount will be deducted. That is floating policy. Fleet policy. A person owns a lot of ships, then for all his ships together, he will take a fleet policy. He will cover all his ships under one particular policy, and that is known as fleet policy. Now, there is specific cover policy. You want to cover different types of risk for a single shipment. This is not suitable for exporters because they will have to take the insurance at every time they go for a voyage. So it's suitable only for people who uh, would like to insure a particular shipment. Now, block policy. While the goods are being transported through the road so that they can reach the port and then transfer it to the ship, there might be some risks involved. They might meet with an accident. There might be some sort of a loss on the way to the ship. Under block policy, it covers the risk that the cargo will face on land and on sea and in sea. Now, cargo policy is for a particular cargo. You are transporting a highly costly cargo, then you can take up insurance for that particular cargo. Port risk policy, any loss that happens to your goods while on port will be covered under port risk policy. So different types of marine insurance policies. The different type of fire insurance policies. Again, there's valued policy, valuable policy. Under valued policy, say suppose you are insuring a building for fire insurance, okay, and you're going to claim every valuable in that building at the time of taking the insurance. So you're going to say, I have this much artworks, I've got this much jewelry in my building, I've got this much sculptures worth rupees this much, and you're already going to decide the price of the compensation amount in case of a loss. So value is predetermined. This is because once the fire has occurred, maybe later on you will not be actually able to find out the worth of the goods that has been lost in fire. The examples are artworks, jewelry, etc. come under this category. Now the problem with valued policy is that you cannot add items after you have taken the policy. You cannot change the policy amount. That is valued policy. Now, what is valuable policy? In this case, the value of the property will be determined only at the time of the loss. Once the loss has happened, they will try to indemnify the loss. Now, what is specific policy? A specific property is insured. You have specifically mentioned what property you need to insure. Suppose you have insured your house. House is worth rupees 40,000. But you have taken insurance only for 30,000. Okay, you've taken a policy of 30,000 under insurance case, Anna. But if through fire you have suffered only a loss of 20,000, then you will be paid only 20,000. If you suffered a loss of 35,000, then your policy amount is for 30,000, so you will be paid 30,000 only. Next one is floating policy. Suppose a person has a lot of go downs, he has got stock everywhere, different localities. He doesn't want to go around taking different policies for each of his go downs. He is going to take a floating policy. So it covers the fluctuating stocks in different localities. Next one is stock declaration policy. See, the problem is when you're insuring the stock value keeps fluctuating, right? The quantity of stock that you hold will always keep fluctuating according to your sales. So if you're going to claim maximum stock that can be stored in the go down, then the premium amount will be too high. And if you're going to claim only a small amount, then maybe you will not be properly indemnified. So stock declaration policy is a solution for that, in which the premium may need to be paid only on the average value of the stock. You will always have an average stock in your go down, right? Only for that average value you need to pay premium. For this, the policy holder will have to make declarations regarding the maximum stock in his go downs from time to time so that they can calculate the average stock. Now there's adjustable policy. In this case, the insurance is taken only for the existing stock for a specified period of time. See, I'm taking the insurance for a period of 2 years and I want coverage for the existing stock only. I do not want to pay premium for the average policy. And I'll keep on making declarations frequently whenever the stock value changes, and the premium amount will also keep on fluctuating depending upon the stock that you hold. There is adjustable policy. There is reinstallment policy or replacement policy, whereby the loss will be compensated by replacing the goods that has been lost in fire. You will not be paid in cash. You will be paid as goods. The goods that you have lost in fire, they will replace it with new products. Then there is loss of profit policy. That is when there is a fire, the business will not be able to engage in manufacturing and sales for some time. And that will affect their profit level. And the loss of profit during that particular period will also be covered under this policy. Then there is comprehensive policy whereby not only the risk of fire is taken into consideration, but the risk of lightning, theft, flood, burglary will also be considered. All these risks will also be covered under the comprehensive policy. In case of building in course of construction, suppose your building was being constructed and that time due to fire you had to suffer a lot of loss, then that risk will be covered under this particular policy. There is transit policy whereby when the goods are in transit by road or rail, the goods got lost because of fire, or you had to face loss because of fire while the goods were in transit in road or rail, then that risk will be covered under transit policy. The last one is sprinkler linkage policy. Under sprinkler linkage policy, so we have most of the factories have automatic sprinklers whereby the water will be turned on when they detect smoke so that they can put off the fire immediately. But sometimes this will not work properly. The automatic sprinklers will start by themselves and the goods will be lost because of the fire. This will be covered under sprinkler linkage policy. It's not linkage, it's leakage. Leakage. Sprinkler leakage policy. The different types of fire insurance policies. Now, the difference between life and general insurance policies, only that needs to be discussed in this module and we'll complete the portions. So what are the different points of differences between life and general insurance? First one is contract of indemnity. Indemnity means you will be only compensated for the loss. No one will be allowed to make a profit out of insurance. In case of life insurance, indemnification is not possible because we cannot actually value the worth of a person's life, right? So we'll just determine a amount that will be paid in case that person loses life. So it is not a case of indemnity in case of life insurance. But in case of general insurance such as fire and marine and other insurances, it is a contract of indemnity. In the event of any loss, the assured can recover only the actual amount of loss will be paid. Now, contract of guarantee. Life insurance is a contract of guarantee. No matter what, everyone will die one day. So the amount is assured. And that is why I say it's life assurance, not insurance, because we are certain that the amount will be paid at some point of time in future. But in case of general insurance, we can take marine, fire, and other insurances. But it is not a contract of guarantee. We do not know whether this circumstance will actually happen. We do not know whether we will have to claim the insurance amount in future or not. Sometimes nothing will happen, and then we will not be required to claim the insurance amount. The measurement of insurable interest. Now, how much interest do you have in a particular person's life? This cannot be measured, right? So in insurable insurance, the insurable interest cannot be measured. But in general insurance, you can clearly measure what is your level of interest in a particular object. How much money's worth of goods did you lose? That you can actually measure in case of general insurance. The insurable interest of the assured in the subject matter is measurable in terms of money in case of general insurance. Now, existence of insurable interest. See, in case of life insurance, the insurable interest need to exist only at the time of contract. Suppose you took your life insurance in the name of your husband, and at the time of the death of that particular person, you have both divorced. You are no longer his wife. But still the insurable interest was there at the time of taking the contract. The time of taking that contract, you were his wife. So you can claim that insurance amount because insurable interest need to exist only at the time of contract in case of life insurance. In case of general insurance, the insurable interest must exist both at the time of the contract and at the time of the loss. While you were taking that contract and when the loss occurred, at both times you should be the owner of that goods. Then only you can claim loss for that amount. You can claim compensation for that loss. Next is subrogation and contribution. These are two of the principles of insurance that I mentioned earlier, right? Subrogation means once the insurance company has paid the insured, then the insurance company gets right over the insured object. Suppose your car was completely burned out in a fire and the insurance company has paid the scrap value to you. Now they can take that car from you and they can dispose it off in whichever way they want. That is the right of subrogation. Now, contribution means suppose you have taken insurance from more than one insurance company. You have approached two or three insurance companies to. Okay, so in case of contribution, you have taken insurance from two or three insurance companies. And the main policy of insurance is that you should not earn profit from insurance. You should only be compensated for loss. So what they will do is that they will calculate your loss and all these insurance companies will together contribute the actual loss that has been suffered by you. So in life insurance, the right of subrogation and contribution do not exist, but in general insurance, subrogation and contribution do exist. Now the certainty of event.
In case of life insurance, there is certainty of event. That is, we are sure that that instance will happen. But in case of general insurance, there is no certainty to the happening of the event. It may or may not take place. Now, life insurance provides protection to the individuals and their investments. There are certain policies whereby you will be paid the compensation amount in case of death of that person, or you will be paid the amount that you paid as premium on completion of a specified period of time. So it is both a protection and an investment. But general insurance, it provides protection against risk. The insured can surrender the life policy before maturity, but in general insurance, surrender of policy is not possible. In case of life insurance, medical examination is compulsory, but in case of general insurance, no medical examination is required. So these are the topics to be covered under the fifth module. With this, we have completed the portions. I hope this much is clear. Thank you.